Welcome. I'm Catherine Magaña here with Rachel Ivanovich, Steve Wolff, and Vince Stefano, where we're here to provide you insights about the markets, planning, and much more. So here we are. Today is October 16th, and we are having some healthy earnings. There's still a government shutdown. We're hearing U.S.-China headlines. Gold is hitting all-time highs. Small caps actually have been up over the last week, which is kind of interesting. And kind of reflecting over the last week, as of yesterday's close, which was October 15th, the Dow Jones is down a little bit. The NASDAQ and S&P are all down a little bit from last week. But the Russell 2000 was actually the winner. It's actually up 1.61% as of yesterday's close. It's at about 12.99% this year to date. And one of the reasons I think for that is because they're anticipating some rate cuts. And with that, some small businesses can benefit with some of the lending and things that they can do. So that ties into kind of where we're at with rate cuts. We've talked about this in the past. So the next meeting is going to be October 28th and 29th. And there is a 98% chance of one rate cut at that time. And there's also a 97% chance of two rate cuts between now and the end of the year. So kind of,
That would be nice.
Yeah, that would be nice.
That would be really nice.
Yeah. So we'll see what happens with that. So kind of I mentioned gold. So gold is actually, as of this morning, we're at $4,264 per ounce. And so it's been gangbusters this year. That's really moved up pretty quickly. And then we're also looking at where interest rates are at with kind of short-term fixed income. I haven't seen a lot of change. So the one-year CD is still at about 3.75%. So I haven't seen too much change on the fixed income section. But I have seen a lot of clients over the last kind of 30 days that have had a lot of cash sitting on the sidelines are now willing to kind of put some money to work. And doesn't mean we put everything to work day one. I mean, we do but we are putting some money to work.
Right at the top,
right?
Right when the market is.
No, long term.
We don't know where the top is. We don't know where the top is.
Short-term top. Anyway,
Matter of fact, that's one of the things I want to talk about.
What was kind of interesting, you mentioned fixed income. I saw the 10-year actually broke 4% today. It was actually had a 3 handle on it, so that was kind of interesting.
Nice.
And you key on the 10-year all the time.
I do. One of the things I want to talk about is whether the market's overvalued or not.
Well, go ahead.
Thank you.
I'll chime in later.
Thank you, because you keep interrupting me, so I figure
that's my job. Catherine tells me to do that all the time.
So is the market overvalued? And it's a question that we get all the time. It depends on what you're looking at. I would say in general we probably are a little bit overvalued, but everyone thinks, oh my God, there's going to be a crash. I don't think we're in that territory. I really don't. Are there some elevated valuation multiples? Yes, there are. I believe that the S&P the PE ratio is now about 22. Historically, it's been 16 to 17. So from that perspective, it is a little bit overvalued. But you have to remember that it's really concentrated in maybe 7 to 10 stocks. So those stocks are really high, which makes the whole average much higher. But if you look at all 500 stocks in there, I'm not sure that that's the case. Although you were saying, Catherine, that the small stocks are starting to move up a bit.
Yeah, over the last week, everything else was down a little bit. The small caps, but the small caps they've been lagging for a while. But
And again, it's interest rate. A lot of it's interest rate driven,
so,
like you said.
So some of the reasons, there's concentration risk, which you just talked about. There's also the risk of exuberance in AI and tech hype. But again, is it really hype? Because everything is moving to AI. This is something that is going to happen over the next 5 or 10 years. AI is going to be changing technology. It's going to be revolutionizing what we do. It's going to be in everything that we do. And of course, then there's people groups like the IMF, who's warned of rising risk of a sharp correction. And a lot of fund managers now believe that equities are overvalued. And even figures like, people like Jamie Dimon, although Jamie Dimon has been crying wolf here for a long time, eventually he's going to be right, but he hasn't been right. Now, the other side of it is you look at earnings. And I know, Vince, you'll probably talk about earnings, and we do all the time.
Yeah, and I looked at the financials that came out this week, and I'll tell you, they looked really solid. Mm-hmm. If you looked at these big financial companies, their investment banking business, their both equity and fixed income trading was up. Their wealth management business was hitting a lot of new records, and also their asset management. So, when the comments that came out of the conference calls were that things were looking solid, the economy was doing well, and it looked like the consumer was still, hanging in there quite nicely. That kind of takes me to, like, what can really derail this bull market? I mean, right now, the path of least resistance continues to be up. And what can derail it? Well, Fed policy, of course, but a lot of people think the Fed.
Well, I was thinking, but how about the China?
Yeah.
And it's like those tariffs, everything seems like every day we're hearing something new, and there's a new headline and a new deadline. And
But meanwhile, the market keeps going
Yeah,
up.
Fed
that's
policy, you got DC policy error. You could have an increase in inflation, and geopolitical unrest can hurt as well. Or you can have a major standard deviation event like we had back in the 90s with long-term capital and the Thai baht or the financial crisis. But a lot of that, that's kind of like what can derail it, but it may not happen. So more than that, I think it's kind of interesting. We're about 10 to 11 weeks before Christmas, and the National Retail Foundation started looking at what may happen during the holiday season. And they're saying that the consumers this year are going to spend around $900 to $1,000, and that's down a little bit, believe it or not, from last year.
You mean per
person?
per family?
Family, per family, which is down from last year. That may not sit well with retailers because they're sitting on a pile of goods. They tried to load up their inventories before the tariffs took a big effect on them. So,
can I just say something that I have been into some retail stores recently? They're already selling Christmas stuff.
Oh, yeah.
And
I think they start in the summertime.
I was going to say it's been at least
it's 10, 11 weeks.
It's been at least a month since I've been seeing this.
So the big question is, what's going to happen with the consumer? The risk for the retailers is, they buy fewer items. The consumer spends less money. So what you may see really soon before Christmas, deep discounting, which is going to hurt corporate margins a lot, and that's not good for retailers. Another curious issue is that right now we're seeing inventory growth at retailers outpace revenue growth. And again, that's not good either. So it depends on what's going to happen with the consumer in the next 10 to 11 weeks. So I'm hoping that everybody around this table, especially you, Catherine, you go out there, you got 2 young kids, you got to go spend like crazy on your kids.
I'm saving for college for them, so no, you get nothing. Just kidding.
You had mentioned something about the market hitting new highs. I've been sitting here pounding the table about buying stocks over the last few months because, and the market has hit new highs. But this is really interesting, and then I'll pass it around the table after this note. Gen Zers, people that are born between 1997 and 2012, they are investing more in the stock market than they are in home buying. Mm-hmm. Now, part of that, and we've talked about home buying a lot, with interest rates being high, mortgage rates being high, the home prices being elevated. But these kids are saying we would rather rent and invest in the market. So I think you're going to start seeing more and more money continue to flow into the market. So again, if you're right, Steve, if we have any kind of little pullback, I think you have to look at your risk tolerance, talk to your advisor about putting together a portfolio that fits your risk tolerance. And if the market comes down, hey, be a buyer because, again, I think that there's going to be so much money flowing into this market over the next 6 to 12 months that you do not want to stay out of it.
Well, that kind of takes me back to whether the market is overvalued or not. And we talked a little bit about earnings growth. Earnings growth is really good at the moment, which is one of the things I keep hearing. Oh, this is the .com all over again. I don't think so. I'm not saying that stocks can't come down because nothing goes straight up, but the .com stocks, many of them had zero earnings. Well, Pets.com, and I don't know, you probably remember some.
Yeah, the other thing about the .comers, a lot of those were these kind of carrier-type companies that had a lot of like lines that they were trying to put through the ground and all that kind of stuff. No one used it. Where the AI boom, everybody's using the AI boom.
But I'm not talking about that because that's more of the Verizons and whatever.
Yeah, there was.
But you had lots of companies that had nothing.
Yeah.
There was no earnings. There was nothing. That's not the case right now. Matter of fact, these big companies, they are making huge amounts of money, and their revenues are skyrocketing. Matter of fact, I just heard something this morning that said NVIDIA was 13 times its revenues, I believe it was, like 5 years ago. And today, at a much higher price, it's still 13 times. So that's because their revenues are just skyrocketing.
Well, it'll be interesting because not this coming week, but the following week.
And wait, let me say the caveat. I'm not telling you should buy NVIDIA, okay?
Okay.
But I thought that was interesting because it's an example of what's going on.
And not this coming week, but the following week. What's that, the week of the 29th or something like that? That's when the big major tech companies will start reporting.
Well, the other thing, too, is that, when you talk about overvaluation, right now interest rates look like they're going to come down. Powell just said something recently that said it looks to him, because of a slowdown, I guess, in labor, that interest rate cuts might be in order. That's a pretty big deal.
Especially coming from him, because we haven't had that
exactly
in a long time.
Well, and as soon as the government does reopen, because we're in a shutdown, you're going to start seeing all of the numbers come out on employment.
Well, I was gonna say they're having a hard time.
The CPI and the PPI. So guys are flying blind out there, not knowing what these numbers look like. So we'll see.
So you mentioned earlier about some of the Gen Z not buying homes, but it's interesting. There are some clients that we work with where the parents or grandparents are actually gifting some money for down payments, and that kind of ties into kind of fourth quarter. We're looking at, as our proactive wealth theme, estate planning. We actually have a webinar coming up on December 4th where we're going to be bringing in a special guest, Geeta Nassiri from Capital Legacy Law, to talk about estate planning laws for 2026. But I thought we'd share a little bit. I know Rachel and I just did a Savvy series recently on a little bit of some of the estate planning rules and changes. And I know you mentioned you just did some gift tax returns, and it comes up very often. Like our clients are always asking. I know. A lot of clients are asking us, do I pay taxes if I give $100,000? And so I thought maybe if you want to share a little bit about.
And it's interesting that you mentioned the parents gifting the children, because my situation was the opposite, where the children gifted the parents. And so they have a big house, parents have a big house, and the kids, they sold their house and they decided to all move in together. And so, true story, did 4 gift tax returns yesterday on tax day. But we did it for a reason. To preserve their lifetime exemption. And so if you did it this way, it was a way of preserving a little bit extra. And so think about it like this. So annually you can give away a certain amount that doesn't count at all towards your lifetime amount that you can give away. And so for 2024, it's $18,000. For 2025, it's $19,000, index for inflation, et cetera, et cetera.
But there's no tax advantage to that.
There is a state tax. So currently, under the old law, so pre-Tax Cuts and Jobs Act, it was set to expire at the end of 2025, and it was going to return to the lifetime exemption amount of about $7 million per person. So death and taxes, you die, they tax you. You live, they tax you. So
they want their taxes.
They want their taxes no matter what. So every year you can give away a certain amount, and you don't include that part as the amount that you can give away in your life. So we filed 4 returns. They gifted $100,000. It wasn't a really huge amount, but they gifted $100,000. So we filed husband to dad, husband to mom, $25,000 each. And $18,000 of it doesn't count. So only $7,000 of that gift counted towards the amount that they give away in their lifetime. And then daughter to mom and daughter to dad, $25,000. So we did 4 $25,000 gifts, but only $7,000 of it was reportable per gift. So
I'm curious, why did it go up and not down? Why did it go from the children to the parents?
Because the kids sold their house and gifted the money to pay off their parents' mortgage. That's what they decided to do.
Well, that was nice of them.
That was nice of them.
That was nice. Well, they're all living together. So,
but
I thought it was interesting.
I hope it's a big house.
And so you talked about the 2020, if it didn't if it's sunsetted, but now with the new
Oh,
rules.
yes, with the new rules, yes, exactly. So starting in 2026, the amount that you can give away in your lifetime is $15 million per person. And I mean, keep in mind, we talked about upstream gifting, I think, on one of the podcasts, but that real estate, if you add in real estate to all your other assets, I mean, you can get up to that $15 million figure pretty easily if you own your home, and if you live in California, your home is worth a couple $1 million and own a few rentals, and then you have your brokerage accounts and your 401ks. I mean, you can get up to that $15 million figure pretty quickly.
And then for 2025, this year, it's
$13.99 million.
Yeah. So at least we're happy to know that the new rules are coming into place for next year, and obviously that was there was a lot of concern.
But there is some planning, when it comes to estate and gift tax, because they're going to get you. At least they want to.
Earlier you talked a little bit about the situation with China and what's going on there. I was listening to the radio yesterday, and they were talking about what's going on with the Communist Party in China. Apparently, Chairman Xi is on a little bit shaky ground. From at least this report I was listening to. And maybe what he's trying to do is say, hey, I am very strong and, I want to stay in power. And, of course, Trump is, kind of that same person. I am very strong and I am in power. So it could just be that these two
are doing power plays. And but 100% or 125% tariff, those are pretty big numbers.
Well, but it's a response to the rare earth materials that China says that we're not going to give to you, or we're not going to let you buy them. So the two largest economies in the world are fighting. Yeah. And I think that means something, but only if it goes for a long time. Supposedly, they're still meeting. There's a planned meeting. I think it's at the end of this month. I'm not sure the date. I did hear that, yeah. But so far that hasn't been canceled. So as long as that's not canceled and they're still talking, I think we're okay. But I think if all of a sudden we have this big war with China, I do think that will have some effect on the markets. Now, having said that, it doesn't stop AI from increasing. It doesn't stop business from continuing to do business. So if there is a pullback, and this is what I think Vince was saying, it would be what I would do myself probably is say, I want to buy more, because eventually that issue with China will be resolved. Now, I don't know how long it'll take, but it'll be resolved.
So, Steve, do you want to share? I know before we started, we were talking about the fear and greed. Do you want to kind of give us an idea?
Yes, I just so happen to have that fear and greed index with me. And interestingly, and I didn't look at it, I don't know if I was here last week or not. I don't know. Time seems to be going away. But we are now in extreme fear territory, which, to be honest with you, that surprised me because the market has been pretty complacent. All right, but we're down to 25 out of 100, 0 to 100, and that's just at the bare minimum to be in that fear in the extreme fear category. So, but actually, I kind of like that because generally speaking, when we're in the extreme greed, it usually means the market's going to tank. But when you're in the extreme fear territory, and it could last for a long time, but it usually means there's upside to come. So there are a lot of winds going in all sorts of different directions right now. And you know what? Follow the earnings, because that's really where we're at. Vince, you would probably agree with that.
I agree with that 100%. I mean, if they're earning and they are raising their forecasts for the next quarter and the quarter after that, they're going to do well, and the market's going to reward them for that. And most of the companies that we've been investing in over the last 3 to 4 years have been raising earnings guidance. A lot of it's in the tech space. A lot of it's in the chip software companies. Even some retailers have done incredibly well over the last couple of years. Now, there could be a stumbling now because of what's going on globally, but I do think that over the next few weeks we'll get a real good read on what third quarter looked like. So, keep your powder dry, because any pullback, I would be a buyer. Because again, as you said, from extreme fear, it's almost like when stocks get upgraded on the street. I mean, that's when you buy them. They get upgraded and the market rewards them for an upgrade. So, hey, extreme fear, I'd be a buyer.
Well, and like
Although
mentioned,
I think, Vince, you'd be a buyer no matter where the market was.
No, there are times. No, I mean there are times when I wouldn't be, but I mean right now everything's looking good. I mean I see what's coming out of the companies, and even the little tidbits that they give. I mean today a major software company came out and said that their fiscal year revenue by fiscal year 2030 is going to be $60 billion. I mean, that's massive. And the market rewarded them huge today by being up like 10, 12%. So again, it's all AI driven. So, Steve, you've been talking AI, and we've all been around this table, and this thing is going.
Right. Well, up until now, it's been the chip companies that have really been doing well.
It's
but now we get to the point where what do you do with the AI? Okay. Yes, everybody wants the chips that will give you the artificial intelligence. But now what do you do with it? And I think there's businesses coming out, which we aren't even talking about, that are private right now.
And then a lot of companies are investing to get more involved with their business, big businesses, to be involved with AI with their companies. So
Correct.
It's like there's a lot of different facets of this that we're seeing growth in.
Right. So that's really, that's not going to stop. It just isn't. But again, markets are fickle. Anything can happen. There could be an exogenous event, and all of a sudden the market goes down. But again, I think we're all in agreement here that on any fairly good sized pullback, you probably want to be a buyer. So, all right. Anything else we need to talk about?
I think that's a wrap for this week.
That's a wrap. Okay. Well, we will be here hopefully next week, and until then, happy investing, and we'll see you soon.
All right. Thank you.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.